All right, let's get into it. Today's market told a really fascinating story. It was one of those days that perfectly captures the mood right now. A real tale of hope and fear, all wrapped up in some logic that feels, well, completely backwards.
So, as requested, I will now cover the stock market conditions for September 8th.
And this brings us straight to the big puzzle of the day. The jobs report for August came out, and folks, it was weak. Now, common sense tells you that should be bad for stocks, right? Weaker economy, weaker companies. But no, the market rallied. So what on earth is going on here? That single question is really at the heart of today's market drama. You have this surprisingly strong rally on a day that by all accounts should have been gloomy, and it tells us everything we need to know about the current investor mindset.
So let's just take a quick snapshot of the action. The Dow was up, the S&P 500 up, the tech-heavy Nasdaq was also up. But look at that last point. U.S. bond yields fell, and they fell sharply. Now that right there, that is a huge clue, and we're going to see exactly why in just a moment.
It all boils down to one incredibly powerful idea: the hope for interest rate cuts. This is the magic key that unlocks the entire puzzle, showing us how seemingly bad news for the economy actually turned into great news for investors.
So here's the first piece of that bad news. Only 22,000 new jobs were added in August. To give you some perspective, that is a major slowdown from what we've been seeing.
And the second piece, the unemployment rate actually ticked up to 4.3%. That's a high we haven't seen since the pandemic. So, the data is crystal clear. The job market is definitely cooling off. So, why would investors be celebrating this?
It's all because of this critical, if slightly weird market theory. Bad news is good news. I know it sounds totally backwards, but the logic goes like this. When the economy shows signs of weakness, like a lousy jobs report, investors start betting that the Federal Reserve, the U.S. Central Bank, is going to have to step in and do something. And their biggest tool? Cutting interest rates. And lower rates are like rocket fuel for the stock market because it makes it cheaper for companies to borrow money, invest, and grow.
And listen, this isn't just some wild theory. The big players on Wall Street see it too. Bank of America, who was pretty skeptical about rate cuts before, basically threw in the towel after this jobs report. They're saying, okay, the signs are undeniable now. The job market is weakening from every angle.
This quote shows you just how high the expectations are getting. Standard Chartered is now talking about a big catch-up cut of 50 basis points. For anyone who doesn't live and breathe this stuff, that's just finance speak for a 0.5% cut. That would be a really aggressive move, and the market is absolutely loving the idea of it.
But here's the thing. Even with the whole market rallying, the day's news created some very different stories for specific companies. It was definitely a day of clear winners and clear losers.
Okay, let's break this down. In the winner's corner, you had big AI players like Broadcom and Oracle rallying on some good news about AI spending. Robinhood and AppLovin got a huge boost after being added to the prestigious S&P 500 index. And look at EchoStar. It skyrocketed 23% on a deal with SpaceX. But on the flip side, that very same SpaceX news absolutely terrified the big telecom companies. The mere threat of new competition from SpaceX sent T-Mobile, Verizon, and AT&T tumbling down.
So let's zoom back out. What we're really seeing is a market that is caught in a classic struggle, a real tug of war between two very powerful emotions: the hope for a helping hand from the Fed and the fear of what might be just around the corner.
Let's look at the two teams in this tug of war. The bull case, the optimistic view, is all about hope. They see this weak jobs data as the perfect green light for the Fed to start cutting rates, which historically has been amazing for stocks. But the bear case, the pessimistic view, is all about fear. They're worried that this job slowdown isn't just a gentle cooling off, but maybe the first tremor of a real economic recession. Plus, there's always the chance that the next inflation report comes in hot, which would tie the Fed's hands completely.
And that brings us to the core tension of this whole thing. The market is basically walking a tightrope. It wants an economic slowdown that is just right. Weak enough to make the Fed cut rates, but not so weak that it throws the whole economy into a recession. It is an incredibly delicate balancing act, and that tension is what's driving everything right now.
And so, this leaves us with the billion-dollar question that every single investor is trying to answer. Is this cooling job market the canary in the coal mine, warning us of a coming recession? Or is it the starting gun for the next big market rally, one fueled by a new era of lower interest rates? The answer to that is going to define everything